Hello, dear students. Hope you all are good. Today we will start Unit 8 Meaning, Characteristics, Functions, and Social and Economic Significance of Insurance. Overview of the session which we will discuss. Define insurance, parties involved in insurance, how insurance works, rights and responsibilities of the insurer and insured, classification of insurance, role of insurance, functions of insurance, characteristics of insurance. Now start with definition of insurance. According to McGill, insurance is a process in which uncertainties are made certain. According to Chief Justice Tyndall, insurance is a contract in which sum of money is paid by the assured in consideration of the insurers incurring the risk of paying a large sum upon a given contingency. In legal terms, insurance is a contractual agreement whereby one party agrees for a consideration called premium to compensate another party from loss. Parties involved in insurance. An insurance transaction involves the following: insurer, the party agreeing to pay the loss of the insured. Second, insured, the party who insured his risk with the insurer. Premium, the payment to the insurer received from the insured for indemnifying the losses. Policy, it is the contract between the insurer and insured that sets the contractual obligation between the two. Exposure to loss, insured's possibility of incurrence of losses called the insured's exposure to loss. How insurance works. The mechanism of insurance is very simple. People who are exposed to the same kind of risks come together and agree that if any one of them suffers a loss, the others will share the loss and make good to the person who lost. All people who send goods by ship are exposed to the same risks, which are related to water damage, ship sinking, and privacy, etc. Those owning factories are not exposed to these risks, but they are exposed to different kinds of risks like fire, hailstorms, earthquakes, lightning, burglary, etc. Like this, different kinds of risk can be identified and separate groups made. By insurance, the heavy loss that anyone or few of them may suffer is divided into bearable small losses by all. In other words, the risk is spread among the community and the likely big impact on one or few is reduced to smaller manageable impacts on all. Rights and responsibilities of the insurer and insured. Firstly, we will discuss the right and responsibility of the insurer. First is right to collect premium from the insured. Insurer has a right to collect in advance a specified sum as premium for his taking obligation of reimbursing the loss to the insured as and when it occurs. An insurer pays the claim to the insured from pool of funds so build collection of premiums. In fact, an insurer loads the premium within his administrative costs, cost, management expenses and agent commission as well up through. Right to specify the rules and conditions that govern the promise made under the policy. Insurer explicitly states as to what risk the policy covers, the terms and conditions subject to which such losses will be reimbursed. Third, responsibility to pay the losses occurred and claimed by the insured. Once the insured suffered losses and lodges claim, the insurer is obliged to honor provided they are within the contractual terms of payments. Now, rights and responsibilities of the insurer are listed. Rights and responsibilities of insured. First, obligations to pay premium to the insurer. The insured has to pay the prescribed premium to the insurer so as to create a contractual obligation on to reimburse the losses as and when they occur the part of insurer. Second, right to collect payment from the insurer if a covered loss occurs. In the event of materialization of risk, the insured is entitled to claim reimbursement of losses from the insurer. Third, obligation to comply with the term and conditions prescribed by insurer. The insured has to comply with all the terms and conditions laid down in the policy and also agreed by him at time of creating the policy. Classification of insurance. Insurance are of two types: life insurance and general insurance. General insurance may be further divided: uh, fire insurance, marine insurance, mediclaim, motor vehicle, and so on. Roles of insurance. The insurance sector supports the financial system in several ways. If you have been enumerated below, it accepts the risk from people and corporate bodies who are exposed to them. Second, it collects small amounts of premium which are pooled together to be called an insurance fund. This fund is used for investment purpose. Third, it organizes compulsory insurance in certain areas as per the provisions of the law. Fourth, it sells voluntary insurance covers through its sale force. Fifth, it settles claims arising out of insured losses. Neither the insurance company nor the insured are allowed to make profits or out of insurance. If insurance company gets a surplus after meeting claims, it distributes it among policy holders in form of bonus or reduction in premium. Sixth, it follows the principle of Indian Contract Act which help to prevent its misuse or abuse. Functions of insurance. Function of insurance are as follows. It helps in capital formation. It provides certainty. It provides protection. It helps prevention of loss. It shares risk or help to reduce risk. Characteristics of insurance. First, risk sharing and risk transfer. Insurance is a device to share the financial losses which might occur to an individual or his family on the happening of a specified event. The event may be the death of earning member of the family in the case of life insurance, marine perils in marine insurance, fire in fire insurance, and others certain insurance, etc. The loss arising from these events, if insured, are shared by all insured in the form of premium which they have already paid in advance. Second, cooperative device. A group of persons who agreed to share the financial loss may be brought together voluntarily or through publicity or through solicitations of the agents. An insurer, by insuring a large number of persons, is able to pay the amount of loss. Like all cooperative devices, there is no compulsion here and anybody to purchase the insurance policy. Third, calculates risk in advance. The risk is evaluated on the basis of probability theory before insuring scenes. The premium payable on a policy is to be determined. Probability theory is that body of knowledge which is concerned with measuring the likelihood that sometime something will happen and making estimates on the basis of this likelihood. The likelihood of an event is assigned a numerical value between 0 and 1. Those events that are impossible are assigned a value of 0, and those that are inevitable are assigned a value of 1. The higher value are assigned to those events estimated to have a greater likelihood or probability of occurrence. Fourth, payments of claim at the occurrence of contingency. The payment is made on happening of a certain contingency insured. It is true for all non-life insurances that payments will be made on happening of the specified contingency only. Fifth, amount of payment. The amount of payment depends upon the value of loss suffered due to the happening of particular insured risk, provided insurance is there up to that amount. In life insurance, the purpose is not to make good the financial loss suffered. Moreover, one cannot estimate the value of a human being. A person is no doubt precious to his or her family. The insurer promised to pay a fixed sum on the happening of an event, that is death or permanent disability. Sixth, larger number of insured person. The price of insurance is basically linked to the cost of claims, which is only known subsequently. In the beginning, it is an unknown factor and an estimate is made on the basis of past claims experience. 7. Insurance must not be confused with charity or gambling. The uncertainty is changed into certainty by insuring property and life, because the insurer promises to pay a definite sum at damage or death. In the absence of insurance, the property owners could, at the best, practice only some form of self insurance.